If you're not ready to hear bad news about banks, then this video is not for you. But on the other hand, if you are keen to hear at least an alternative point of view or just a balancing point, because everybody is so hyped up about banks, correct? Then maybe I have something to share with you. Actually, the warning signs have been coming. In end of July, analysts were already expecting DBS, OCBC and UOB second quarter results to be weighed down by lower interest rates. And kaboom, OCBC actually released earnings 1st of August, reporting profits falling 7%. And OCBC again is the first of the three banks to release earnings. DBS and UOB will be releasing on 7th of August. And if you're keen, smash on subscribe. I'll try to do a second deep dive to share with you more findings. And you know, I've been on YouTube for quite some time already. Yes, it's true, I've been calling banks expensive for a very long while, and share price of banks have just keep running up and up. So before some haters leave comments below, let me share with you again year-to-date performance of our three big banks. DBS year-to-date 8.9%, OCBC year-to-date 0.6%, and UOB year-to-date is actually negative already. If you look across, all three banks are not even top 10 performers of our index. And this is very unlike the last 5 years whereby banks have been leading the index. Right at the very top, you see ST Engineering, you see Sembcorp, you also see even Singtel. Again, when I show you this, I'm not saying that our banks will crash tomorrow. Nobody knows. I'm not saying our banks are bad franchises. I'm just saying they've been carrying the index for so many years. It is likely that they are expensive, and it's also why we can look for alternatives and let the valuations catch up to their price. Hopefully my point of view is clarified, and with that, let me share with you what OCBC has recently published. Over here is first half 2025. You'll see net interest income dropping 5% year on year. Net interest income again is a bank's biggest revenue source. I've seen many in the comments neglecting that this is the biggest pie and expecting the rest of the non-interest income to more than cover for this loss. Bank is a bank, it's not a wealth management firm. If you're looking for wealth management, you might as well invest in iFAST or UBK here. But banks make monies predominantly from interest income, as always should be. And with net interest income dropping, you'll see that net profit has also dropped 6% year on year. And if we deep dive further on net interest margin, you realize that it has dropped 25 basis points on a 1 year basis, with the latest close at 1.98% only. Previous quarter, I've done the homework, is at 2.04%. So even quarter on quarter, it's slipping. Yes, it's true that consumer loans are growing, high single digits. I think DBS has also mentioned that they're expecting that. But if your rate is dropping, the amount of loan growth needed to cover that is very big. So net, there is still a decline in net interest income. And what if a recession comes? Banks, they'll see a slowdown in loans, correct? Because recession, what? So businesses are not taking loans, people are not buying properties and stuff. And what also happens? There's going to be bad debts, and this will directly impact a bank's profitability. So is everything gloomy and doomy? Yes and no. There are some bright spots just to minimize the damage. And over here, OCBC actually has big contributions from Great Eastern Holdings. I used to own Great Eastern shares, but they purchased it off me, and now Great Eastern is going to float again. But that saga is for another video. I'll try to leave links for my Great Eastern Holdings investment if you're keen to find out previously above. So Great Eastern Holdings, I wish I kept it. Right now, profits are growing 10%. But again, this area which I've shaded in green is still not enough to cover for banking net profit decrease. But all in all, I would still like to congratulate OCBC for picking up more Great Eastern Holdings shares, because this still helps them diversify the books. Which makes me think, UOB, if I'm not wrong, is less diversified. If net interest income drops for UOB, they could be slightly harder hit than OCBC. But back to OCBC, interim dividends are declared at 41 cents. So the yield right now is about 5% only. And the main part is 41 cents is actually a dividend reduction from previous year. Dividends again cannot be sustained. It's a dividend reduction. Again, I know there are many supporters of banks because they've rewarded investors well over the last few years. I'm still highlighting this is likely a high cycle, and the worry is that banks will need the valuation to catch up to the price. Let me show you something else that's concerning to me. Over here, you see that in 1 year, OCBC has increased from 14.80 cents to 16.80 cents. $2 increment, which is about 13.45% increment. All this, when we compare year on year, is now a 7% worse performance, and yet you're paying a 13% price increment. Does that make sense or not? Probably not, right? It's not ridiculous to call it expensive, right? From a 5-year historical price to book, which is what banks are measured on, 1.25 times right now is one standard deviation above average. Also a premium above sector average right now. So expensive? Look elsewhere lor. I mean, it's not like we need to only buy banks, right? I've shown in previous video, which are links above, 7 other ideas that you can invest, especially when the small mid-cap stocks in Singapore are recovering strongly right now. So if you like to buy Singapore stocks, Longbridge is currently offering $0 platform and $0 commission. And in addition, with my unique referral links below, you can get an $18 cash voucher as well as free US stocks like NVDA and Apple. Again, look for my special referral links below. Over here is a 3-year chart. You see the OCBC for this example has shot up from $10 to $17. A very steep climb over the last few years. And on this chart, we can see something from a trader's point of view that looks like a double top. First peak in March before Donald Trump's tariff crash, and then now it seems like sucking in all the last minute investors, which is why a double top is typically a very dangerous situation on a technical perspective. If we move to a daily chart, you realize that last week has shown tremendous amount of weaknesses, with share price closing down consecutively for 5 or 6 days. You see over here a typical double top formation, 2 peaks, and then a consistent sell down day by day. If this is true, it's going to take OCBC a while to find a new all-time high. Again, not saying that it's going to crash tomorrow, but in the near term, it could trend downwards and stay lower for a substantial period. This again is near term. 1 year later, I put there question mark because nobody knows what will happen. There could be a new breakthrough and reach all-time high again. Let me know what you think. And as always, a place that you can express that is in my Telegram group. Many are ignoring this downturn as long-term investors, which is okay also. As always, look for links below to join in this private Telegram channel. Reiterating, my message is not to sell everything and go hiding. My message is, it's quite likely banks are expensive. Look elsewhere. Hopefully this resonates. Smash a subscribe. Once DBS and UOB release their earnings, I'll share them with you. Maybank seems a bit optimistic. They are suggesting that DBS and UOB may have potential to surprise on the upside from better wealth management and trading income. However, dividend surprises are unlikely. Thank you for watching right at the very end. I have this few previous videos that you can check out too. Invest safely as always. Goodbye.